Well, hello and welcome to our Chapter 9 video lecture. Chapter 9 is a very exciting chapter. We're going to focus on financial statement analysis. So, here in Chapter 9, we're going to focus on how accounting information is going to be useful for decision making. Okay? So we'll talk about how the information will support decisions made by those both internal, those inside of the company, and those external. So what accounting does, it provides information to help the intended users make some type of financial decision. The main source of data will come from the financial statements. So now we're going to analyze the information shown on the different types of financial statements. Okay? So who are the users of financial information? Well, that list can be exhaustive. Anyone or any organization that wants to make a decision about a company may become a user of a company's financial information. But some groups may include managers, creditors, stockholders, investors, agencies, or examples of different organizations or individuals who become users of financial information. Okay? So just as the knowledge level of potential users varies, the information needed will vary as well. So if someone makes a decision about whether to loan you money or not, they're going to need different information from someone who try to determine if they want to invest in your business. Or the IRS may look at your information to determine what is going to be your tax liability. So here we have what's called financial statements. These are reports prepared on a periodic basis that provide information about a business. Now, sometimes if there's too much detail, there can be what we call an information overload. I can't understand all of this information. So in chapter 9, we're going to break down that information into what we call financial ratios. All right. So we're going to turn how to take the information shown on these financial statements and use a variety of analysis techniques called financial ratio analysis. All right. First, we'll look at the difference between a horizontal analysis compared to a vertical analysis. Okay. So, financial statements analysts should focus primarily on the information useful for their decision making process. So, again, if I'm a creditor, I'm probably going to focus on more of the liability section of the balance sheet as well as the assets section. So, what horizontal analysis does, we take a look at it looked at the absolute amounts, the actual dollar amounts, and the different categories. But then it'll take that information and show it as a percentage. And we'll discuss that. And then with the vertical analysis, we'll talk about what does that mean as well as ratio analysis. But keep in mind the intent. The intent is to break down the information on the financial statements. So for you, it becomes useful financial information. So here we have an income statement and retained earnings statement for the Millivac Company for both year 3 and for year 4. So it's showing their sales, cost of goods sold, gross margin, their expenses, their net income. Then it shows the beginning retained earnings less dividends to compute their ending retained earnings. Next, you have the balance sheet for this company for year 3 and year 4. It's showing their total assets. It's showing the liability section as well as their stockholders' equity. And we see that assets equal the liabilities plus stockholders' equity. Now, with a horizontal analysis, also called a trend analysis, it's the study of behavior of certain information on the financial statements, such as the net income. We're now saying what is the trend of net income over a specified time period? Was there an increase in net income or a decrease in net income? And if so, by what percentage? So with the analysis, we're going to take a focus on trends and not just absolute dollar amounts, but also trends in terms of percentages. Okay? So the absolute amount is the dollar amount shown on the financial statements. So now we're concerned about how these amounts have changed over time from one quarter to the next quarter, from 1 year to the next year. We'll focus on that. Okay? Comparing only absolute amounts have drawbacks because materiality levels differ from company to company or even from year to year. Now let's take a step back. What we mean by materiality? Well, materiality refers to information that has a relative importance. So we're saying information is material if it has an impact on your decision making process. So as you are reviewing these financial statements, we're going through to say what information is material, meaning what information will have an influence on the decision that I'm trying to make. Okay? General accepted accounting principles, GAAP, permit companies to account for immaterial items in the most convenient way, regardless of technical accounting rules. So, in essence, again, our focus right now is on what information is material on the financial statements, meaning what information will have an impact on my decision making process. To do that, we focus on what we call percentage analysis. Percentage analysis involves computing the percent relationship between two amounts. And we'll go over that. In horizontal percent analysis, a financial statement expressed as a percentage of the previous balance for the same item. So we're going to compare data for year 3 against data for year 4, but in a percentage format. So we're comparing the two periods. We'll first choose the base year, which will typically be the first year. And then from there, we'll calculate whether there was an increase or a decrease in terms of percentages. Okay? So that's a lot of background information, but now let's look to some actual calculations. So here we're showing the sales beginning with year 1 through year 4. All right? And here we're going to show the increase over year 1 sales. So year 1 is your base year. These percentages are going to be based upon, not using the word basis too much, but the percentages are predicated upon the year 1 numbers. So let's take a look at year 2. In year 2, sales increased to $750,000. That's an increase of $150,000 from sales in year 1. But we're showing that as a percentage. If you take the 150 divided by 600, that means sales increased by 25% in year 2 compared to year 1. Okay? Then for year 3, again, sales increased by 200,000 compared to the base year of year 1. So if you take 200 divided by 600, that's a 33.3% increase. And then the same thing for year 4. Once again, you're comparing year 1 sales to year 4 sales. Sales have now increased by $300,000, which is a 50% increase over the year 1 sale. Okay, so that was the first categories. Now for this way, it shows increase over the preceding year. So not from year one for each of these, but for example, it'll be the same for year two, because from year one to year two, we see that sales increased by 25%. But now you're comparing year two to year three. Sales increased by 50,000 from year two to year three. You're now taking that, and I should have told you, got your calculator. You're now taking 50,000, dividing that by $750,000. Therefore, from year two to year three, your sales increase by 6.7%. Okay. And then we'll do the same thing here. We're comparing year three sales to year four sales. $100,000 increase. Sales from year three to year four increased by 12.5%. So we're doing the analysis. You are now comparing information from year one to, or from one year to the next. In this illustration, we're comparing year one numbers against, year three numbers against year four numbers. And we're showing the difference as a percentage. If it's a positive, it means the amount increased. If it is a negative, we see the amount decrease. Now, why do we do that? Well, we see that in year three to year four, our sales increased by 12.5%. And we're saying, wow, that's good. But your cost of goods sold, which is an expense, it increased by 27.1%, which overall gave us a decrease in gross margin of 9.4%. Okay? Now, what helped us was our operating expenses decreased by 11.4%, which gave us an increase in income before income taxes of 5%. Okay? And then overall, the income taxes decreased by 5.6%. And overall, we had a net income increase of 13.6% from year three to year four. So with the horizontal analysis, you're comparing data from one year to the next year. Now with vertical analysis, you use percentages to compare individual components of financial statements to a key statement figure. So whereas horizontal analysis compares one period to the other, vertical analysis is comparing information on the same time period. So let me show you what that looks like. So here we're looking at year four. And here we're showing sales. Sales will equal 100%. Now, each other number for year four is shown as a percentage of your sales. So cost of goods sold, 610, represents 67.8% of our sales. So if you take 610,000 and divide that by the 900,000, that'll give you that 67.8%. So each of these numbers are shown as a percentage of your sales. So our net income, 25,000, represents 2.8% of our sales. So we take 25,000 and divide that by 900,000. That'll give you 2.8%. So with vertical analysis, we do that for both years. We're taking each line item as a percentage of our sales to say that, again, our gross margin represents 40% of our sales amount. Okay? So stay tuned for part two of our Chapter 9 video lecture. We're going to focus on some more different type of ratio analysis. See you soon.